Welcome to this explainer. Today, our goal is absolutely crucial. We're going to separate the funds that mechanically build your wealth from the ones that are perfectly designed to just quietly extract it. We're clearing away all that Wall Street noise to look at exactly what you should own, and honestly, just as importantly, what you absolutely shouldn't. Okay, let's dive into this. Look at this staggering number, $200,000. That is the amount of money the average investor can easily lose over a 30-year investing career. And you know what the truly shocking part is? You don't lose this massive sum from picking bad stocks or, terrible market timing during a crash. No, you lose it through a slow, silent drain. It comes entirely from hidden fees, duplicated fund exposure, and buying into these slick financial products that just siphon off your returns year after year without you ever even realizing it.
So I've got to challenge you right now. What is actually inside your portfolio? If you're like most of us, you probably picked a few funds because, well, a coworker mentioned them, or they just sounded kind of reasonable, right? Or maybe you simply accepted the default target date option in your workplace 401k. And then for years or even decades, your money just sits there. But have you ever actually opened up the hood and audited what those funds hold?
Well, today, we're going to fix that blind spot with a really clear, practical framework. Here's our agenda. 1. The $200,000 mistake. 2. What is an index fund? 3. The 3 essential funds. 4. 7 funds to avoid. And 5. Optimize your tax placement.
Let's jump right into Section 1, the $200,000 mistake and exactly how everyday investors are quietly bleeding their wealth. So there are 3 silent wealth drainers constantly at work in most accounts. First up, hidden 1% management fees. Then there's massively duplicated fund exposure. This is when you think you're diversified because, hey, you own 10 different funds. But really, you're just buying the exact same large tech companies in 10 different expensive wrappers. And finally, complex Wall Street marketing. Remember, you do not lose that $200,000 from the market crashing. You lose it simply by buying into financial products that are perfectly designed to extract value from you rather than build it for you.
To fix this, we really need to establish a baseline. So Section 2, what is an index fund? Wall Street has spent 40 years blurring the lines, so let's clearly define our terms.
A true index fund is a pooled investment vehicle that mechanically holds every single stock or bond in a specific index in the exact same proportion. Notice that word mechanically. A true index fund does not try to beat the market, it just matches it. And because there's no highly paid human managers sitting there making active predictions, human error is completely removed and the management fees stay at absolute rock bottom. And this brilliantly illustrates the stark contrast. On one side, you have the elegant simplicity of a true index fund, mechanical, market matching, and incredibly cheap. On the other side, the actively managed fund. These rely on human decision makers who are constantly trying to outsmart the market, and they're charging you high fees for the effort. But the data over the last 40 years is unbelievably clear. Roughly 90% of actively managed funds actually underperform their benchmark index over a 20-year period. Think about that. You are effectively paying a premium fee for a 90% chance to lose against a simple machine. No way, right? Let's move on to Section 3, the 3 essential funds. This is the core trio that literally gives you ownership of the entire developed world. You really only need 3. First, the total U.S. market fund. While the famous S&P 500 holds only the 500 largest companies, a total market fund holds essentially every publicly traded American company, over 4,000 of them. That extra exposure to medium and smaller sized companies is where a lot of historical outperformance actually hides. Second, the International Developed Markets Fund. The case for owning great global brands outside the U.S. isn't unpatriotic. It's just math. Right now, international developed markets trade at substantially lower valuations, and buying at a better starting price historically correlates with much better long-term returns. And third, the bond market fund. Look, bonds aren't exactly exciting. They're not going to double your money overnight. But what they will do is provide immense psychological stability and drastically reduce your portfolio's volatility during those inevitable market crashes.
Now, what's really interesting about this slide is how completely simple yet incredibly comprehensive this one portfolio is. Take a look at this sample long-term allocation. 60% U.S. market, 25% international, 15% bonds. With just these 3 funds, you own essentially every publicly traded company and bond in the developed world. It requires practically zero maintenance, you pay almost nothing in fees, and you totally eliminate that massive risk of overlapping your investments. But what about all those other options sitting in your account? That brings us to Section 4, 7 funds to avoid. We're going to expose the financial industry's biggest traps right now.
Before we name them, just look at the devastating visual impact of a mere 1% fee over 30 years. On the left, your low-cost index fund balance sits at a very healthy $2 million. On the right, an actively managed fund with the exact same underlying performance leaves you with only $1,500,000. That 1% fee quietly extracted a full quarter of your total ending balance. $500,000, poof, gone. And all without you ever even noticing the leak.
So let's rapid fire unmask these 7 wealth extracting traps. First up, target date funds. Now, these are only a trap if the fee is over 0.5%. Otherwise, you're just overpaying for a basic basket of funds. Second, leveraged funds. These suffer from a weird math quirk called volatility decay that basically eats away at your money daily. They are built for day traders, absolutely not for your long-term investing. Next are thematic funds, like those flashy AI or cannabis ETFs, which are really just trendy baskets of stocks. By the time a theme is popular, you're already paying premium prices due to recency bias. Then we have single country funds, which concentrate your risk dangerously into one nation's unpredictable political events. We also want to watch out for high dividend funds, which inadvertently bias your portfolio toward older, slower growing industries. Sixth is active funds, where, as we saw, 90% historically failed to beat the market. And the final trap, heavily marketed funds. This brings up a crucial point you really have to ask yourself. Who is actually paying for that marketing? When you see a massive TV commercial or a glossy magazine ad for a fund, you need to shift from being a passive consumer to an active auditor. Funds that compete on ultra-low fees simply do not have the profit margins to run huge marketing campaigns. So if a fund is heavily advertised, that marketing is being funded by the high fees extracted directly from your account. Now for our final highly practical secret weapon, Section 5, optimize your tax placement. Because believe it or not, where you hold your funds matters almost as much as what you hold. Let's move to and see how this builds into the ultimate cheat sheet for protecting your wealth from the tax man. A 401k or traditional IRA grows tax-deferred, making it the absolute perfect home for your bond funds, shielding all their regular interest payments from your annual taxes. A Roth account grows tax-free forever, right? Making it the ideal place for your highest growth assets, your stock index funds. And a regular taxable account is perfect for highly tax-efficient holdings like the total U.S. market fund, which generates very low taxable distributions anyway. Now, you might be wondering why even bother with this, because optimizing your tax placement costs you absolutely nothing, yet it can boost your real after-tax returns by 0.25% annually. I know, it sounds small, but compounded over 30 years, that simple, totally free reorganization translates into tens of thousands of extra dollars sitting right in your pocket. Which leaves us with this final, vital question. Is your portfolio built to extract wealth, or is it built to actually build it? It's time to log into your 401k and your brokerage accounts. Do the audit. Cut out that duplicated exposure. Ignore all those flashy, heavily marketed traps we talked about, and stick strictly to the beautiful simplicity of the core 3 funds. Look, the financial industry exists to sell you complicated products, but the willpower to stick to the simple path, that is exactly what separates those who transfer their wealth to fund managers from those who keep it for themselves. So, are you ready to take back your $200,000?